Do you ever feel like the market's reversals catch you off guard? One moment, it's climbing like a rocket, and the next, it's plummeting, or vice versa. What if I told you there's a simple yet incredibly powerful candlestick pattern that can help you spot these reversals with high accuracy? Enter the Tweezer top pattern class. Today, we're going deeper than ever before. We'll break down every single detail, analyze live charts, and build a robust strategy for beginners and advanced traders alike. Are you ready? Let's dive in. By the end of this video, you will know what a Tweezer top pattern is, the psychology behind their formation, and how to integrate them profitably into your strategy. Watch till the end. Don't miss this. So what is a Tweezer top candlestick pattern? The Tweezer top candlestick pattern is a bearish reversal candlestick formation at the peak of an uptrend, marked by two consecutive candles with nearly identical highs, signaling strong resistance and a potential shift in market sentiment from bullish to bearish. What's the psychology behind its formation? In an uptrend where buyers are in control, pushing prices higher, the first bullish candle represents their dominance. However, at the same price level, sellers enter with full force during the second candle, halting the uptrend completely. This creates a double rejection at a specific price, signaling a potential reversal as market couldn't form or sustain a new high. What are the characteristics of identifying a Tweezer top pattern? 1. Identical highs. The highs in a Tweezer top should match almost perfectly, involving two or more candlesticks, and could be composed of real body or wicks. This shows a clear rejection of a specific price level. 2. Significant trend before the pattern. Tweezer patterns work best after a strong trend, not in a ranging market. The bigger the trend, the stronger the reversal signal. So a Tweezer top should come after a sustained uptrend or price rally. Number 3. Candlestick size matters. Large first-bodied candles that makes up the Tweezer top pattern are more reliable because they reflect significant buying pressure before a sudden introduction of an opposite or opposing bearish price sentiment. Moving on, there are advanced methods for trading the Tweezer top pattern, which are 1. Alignment with higher time frame trend. Tweezer's top pattern should always be traded in alignment with the general market trend. Though a Tweezer top should be identified in an uptrend, the overall market identified from either higher time frame or prior price movement should signify downtrend, as this would increase the reliability of the pattern. 2. Integration with indicators, such as RSI or MACD. Combining Tweezer patterns with other indicators for additional confluence increases its effectiveness, such as divergence in RSI or MACD. From the illustration above, market is clearly trending higher, forming higher highs, but on a closer look to the 14-period RSI indicator, it shows a lower low, an opposite movement to market price, and signals an opportunity to go short. We will explain deeper later on in this video. 3. Integration with volumes and key zones, such as psychology levels, resistance zones, and Fibonacci levels. The integration of the Tweezer top candlestick pattern with volume analysis and key zones, such as psychological levels, e.g. round numbers like 1300 in EUR USD, resistance zones where prior price action has stalled, and Fibonacci levels, e.g. 61.8% or 78.6% retracements, significantly enhances its reliability as a bearish reversal signal by aligning the pattern with critical market turning points, while volume spikes during the second, bearish candle confirm the presence of strong institutional activity or heightened selling pressure, indicating a more decisive rejection of higher prices and an imminent trend reversal. Before we continue, don't forget to subscribe or follow. Next, variations of the Tweezer top pattern. The Tweezer top candlestick pattern has multiple variations that enhance its interpretive depth and effectiveness as a bearish reversal signal, such as when the first candle is a large bullish candlestick and the second candle forms a harami pattern, indicating indecision and reduced buying pressure. A hanging man, showing selling pressure at the highs. A shooting star, signaling strong rejection of higher prices with a long upper wick. Or a dark cloud cover, demonstrating a bearish engulfing tendency as the second candle closes below the midpoint of the first, with each variation reinforcing the overall reversal potential when accompanied by resistance zones, volume spikes, or alignment with psychological and Fibonacci levels. And finally, confirmation and entry. direction of the tweezer top candlestick pattern varies depending on the specific variation, as certain combinations provide immediate bearish signals upon completion, while others require additional candlestick confirmation for higher reliability. The need for confirmation is influenced by the strength of the bearish reversal signal inherent in the second candlestick. Strong reversal candles, e.g., shooting star, dark cloud cover, provide sufficient evidence for entry, while weaker or neutral reversal candles, e.g., hanging man, demand a follow-up candlestick closing below its body to validate the bearish sentiment. For this example, we have a tweezer top pattern of a bullish candlestick and an harami candlestick pattern, which requires no more additional confirmation, but can be traded with other confirmation confluence to increase its reliability. So we set a sell limit after its formation and place our stop loss above the resistance level formed by the tweezer's top pattern and target the next support for take profit or a 1:2 risk to reward. Let's explore more examples on a live chart. Here on the EUR/USD 4-hour time frame, the overall market trend is bearish, consistently printing lower lows. However, the market is currently in a bullish rally, approaching our point of interest, POI, which aligns with a key resistance zone. On closer inspection, as the market reached our POI, it printed a harami pattern and later came back for a retest, forming a tweezer top pattern in the process. Interestingly, this also resulted in a double top formation, signaling a potential reversal. Upon further analysis, we observe that while price is forming a lower low from the marked resistance zone, the RSI indicator shows the opposite, a higher high, creating a clear price divergence. This divergence adds a strong confluence to the existing tweezer top and double top patterns, increasing the likelihood of a high probability short trade. Now it's time to go in, then we place our stop loss few pips above the tweezer top pattern and target the next support. Always remember to actively manage open positions. This is a trade I executed, and as you can see, it's still active and close to the take profit level. Now let's look at another example. Here on the same EUR/USD 4-hour time frame, the market is trending upwards, consistently forming higher highs. On closer analysis, the price is moving within an ascending channel, but when we shift our focus to the RSI indicator, it's forming a descending channel. This divergence between price action and the RSI signals potential weakness in the uptrend, prompting us to pay closer attention to what the price does next. We identify our POI, a resistance zone where we anticipate price might react, and wait. As the price reaches this zone, it forms a tweezer top pattern. After a pullback and retest, the market forms another tweezer top pattern, further confirming a potential short opportunity. You could enter after the first pattern, but the stop loss would be too large, so I waited for a pullback in order to reduce risk ratio. This second tweezer top, combined with the formation of a double top, provided additional confluence. Now we enter, place our stop loss above the pattern, and target the next support for take profit or a 1:2 risk to reward, and eventually take profit was reached. By combining patterns, indicators, and careful trade management, we can create high probability setups with minimized risk. That's it, traders. Tweezer top and tweezer bottom patterns can be a game changer when used correctly. Remember, practice is key, so spend time backtesting this strategy and applying it to your demo account before going live. Remember, these patterns are just one piece of the puzzle. Successful trading requires discipline, risk management, and continuous learning. If you enjoyed this deep dive, make sure to like, subscribe, and share this video with your trading community. Let me know in the comment section what topic you would want us to cover next. From DMFX Trading School, happy trading!